welcome to this special Indianomics where we are looking at the goings on in the two largest economies, US and China, and their impact on Asia and India. The US first, the consumer price and the producer price data have shocked financial markets. While the US January CPI number came in at 3.1 year on year versus market expectation of 2.9, the producer price inflation was worse. It is their wholesale price inflation. It rose by 0.3% month on month versus market expectation of just 0.1%. This is the highest rise since 1 year ago. So, does the Fed remain tight for a longer period than the market anticipated? On the other hand, when we come to China, there is a growing fear that China is gaining more market share globally and is cutting prices aggressively, creating a deflationary force. How will all this impact emerging markets like India, our bond yields, and the Indian currency? I have with me two experts. First, Chetan Ahya, the chief Asia economist of Morgan Stanley, and in a bit I'll be joined by Sameer Goel, the macro strategist at Deutsche Bank. But first, Chetan, welcome to the show. Let me start with the US inflation numbers. The PPI numbers are particularly stronger than expected. Do you expect now the rate cutting cycle to be pushed and therefore the yields as well to remain strong?
So, Latha, we actually were already forecasting that US inflation will sequentially go up in the first quarter. And actually, the numbers were even surprising to us. So, this is definitely a factor that will hold the Fed back from the earlier rate cuts that markets were pricing in. We have been at June rate cut, and we maintain that. And we still think that the Fed will be able to cut rates in June because we're expecting that sequential inflation will begin to narrow again or decline again from the second quarter of this year. And at the same time, we're expecting that the job prints will also begin to slow. There is some residual seasonality that affects the numbers for January, and we think that January numbers were definitely bumped out a bit too much. But going forward, jobs prints will also slow. And so the combination of that sequential slowdown in inflation as well as job slowdown will allow the Fed to go ahead with a rate cut in from June of this year.
Now let me come to the other part of the US, the fisc. You know, the October, November, December fiscal borrowing indicated that, if you multiply it by 4, then it indicates that the US may run a pretty high fiscal deficit this year as well. 8.6% is what one economist calculated. If that is the case, even if the Fed were to cut, will we see too much of fall, especially in long tenor bonds? Because the Fed is going to, the Treasury is going to keep issuing them. What's the view on the longer term yields?
So ultimately, it will be, of course, the long-term yields will be driven by what is the Fed's guidance on the short-term rate path. And right now, markets have obviously run ahead and begun to discount rate cuts from March, and that's been pulled back, which has pulled the 10-year bond yields also higher. But from a deficit outlook perspective, we are expecting deficit to be at 6.1%. There is a bill that is pending in the for Senate's approval. If that gets done, that's a tax reduction bill that will be taking deficit estimates to 6.5%. But so call it 6 to 6.5% is our deficit estimates for this year and next year.
Okay. It's just that the Ukraine war is now imposing more demands. But okay, with that, let me come to China. Your report was surprising and a little scary. Can you tell us exactly how much of a deflationary force China is? I believe they've been cutting global export good prices.
So China is definitely going to be a deflationary force to reckon with. We are seeing that right now, export prices in dollar terms are in deflation. China's non-commodities PPI index is also in deep deflation. And so these aggregate numbers are definitely indicating that. But if you look at even from a sectoral perspective, what we're seeing is that China has already been sort of deflationary for some of the large items, low value added exports like durable goods, white goods. But at the margin, where we are seeing greater pressure is the new energy transition related goods, which is electric vehicles, lithium batteries, solar panels, and even old generation chips, which is not in the new energy transition related sectors, but outside of that, it's a big component. When you look at the semiconductor sales, 40% is in this old generation chips. And China is actually exerting downward pressure in that segment as well. So it's quite wide based export segments which are seeing deflationary pressures from China. And we think to the extent to which the policy narrative right now is that we want to do the restructuring in property sector, we want to do restructuring in the local government balance sheet, but we want to focus on good sources of growth, and that is manufacturing investment. And so, to that extent, that the government is still, driving that top-down approach to push for manufacturing investments, even while they have the excess capacities. We have to be watchful of competitive and deflationary pressure that China will send to the rest of the world.
If China is such a deflationary force, where does that leave India actually? Is it that for instance, we already hear Indian steel companies are pretty worried about this deflationary impact of China. How will the RBI react, for instance? Because we still have high food inflation. The last number we got was 8.3% food inflation, although core is falling, partly because of factors like China. Where does this leave the Reserve Bank? They're faced with this deflation, but you can't cut because your headline inflation is not 4.
So RBI, Latha, we've debated this probably in the previous sessions on your show. It is focused on headline. I think there is no going back on that. So RBI will have to look at the headline inflation. If food inflation is persistently staying high, RBI will have to look at that. So there is no debate on that front. Now, as far as India's overall implication out of China's deflationary pressures is concerned, I think it is on a macro level beneficial. Of course, there will be some sectors which will be negatively exposed. But to the extent to which India has its own domestic demand-driven strength, if you get this deflationary pressures from China that keeps core goods inflation within CPI somewhat low and gives you an overall CPI outcome which is better, and gets you closer to RBI's goal of 4%, I think it's net beneficiary. It's a challenge for countries which are more dependent on trade and exports as a growth driver. And then those companies, and that will have a negative macro effect for those economies. But for India, we think that there are other drivers to growth other than trade, and these competitive pressures will be less challenging.
So your equity analysts are not worried that cheaper Chinese steel may impact margins here. Some time back there was this huge fear. Toys, chemicals, pharmaceuticals, steel, everything coming from China was a threat and dampening Indian margins. No such fear this time.
Well, I think at the margin, it is not as bad as 2015-16 when you had China's PPI at minus 5.5%. But it's definitely, as I said, going to be negative for some sectors. But at an aggregate level, we are less worried about India's macro implications.
Okay, well, a final question on India's growth. Even Somanathan, the finance secretary, when I spoke to him, is not betting on 7, though the RBI said the number 7. What's your sense? Can there be a fear that growth has not broadened at the bottom of the pyramid? There are economists who point out urban demand is already slowing a bit, or at least not rising. As well, the PLFS, the labor force survey, indicates that jobs are increasing only in unpaid family labor, but not in salaried at the pace that one would like. So will this lack of broadening of the pyramid stymie India's growth pace?
Well, Latha, I think we are seeing that sign of broadening. There are two debates on this broadening story. One is when will the consumption trend broaden from urban to rural? And similarly on investment, when will it broaden from public to private? Whereas if you see the signs in the marginal data points, we think both those trends are already beginning to emerge. So for the consumer goods spending, the feel that we get that the rural sales is not doing well is because of the price cuts. They had done the price hikes earlier, then there is price cut. But if you look at the volume numbers, even for this December quarter, it looks like we have 5-6% real volume growth in rural economy, and that was contracting earlier. So there's a clear trend that rural consumption is improving, even for items like FMCG products. And similarly, if you look at two-wheeler sales volume, our analyst tells me that that volume growth that we are seeing in two-wheeler sales is also happening because of rural demand improving. So we are seeing that broadening out. It's just happening.
Okay.
And one other thing that I would like to highlight is that when we are thinking about rural consumption and broadening out of consumption, this cycle will be similar to what happened in 2003 to 7, where initially it was capex that was picking up, and consumption was lagging. And within consumption, the urban consumption started to do well, and then rural consumption was picking up. Because as such, understand that the rural economy does not have any big indigenous source of income other than agriculture, which is growing at 3%. So it has to be the migration of rural workers to urban, and then them doing the transfers to the rural economy. And whatever is the government support in terms of redistribution spending. So the big driver tends to be the urban economy first, and then consumption.
Yeah, urban economy and the urban remittance, and perhaps that leading to an overflow of growth to rural areas. We are looking forward to that trend. Perhaps it will pick pace after elections. Thank you very much, Chetan Ahya, for your analysis of the impact of the US and Chinese economies on India. We have to take a quick break. Thereafter, we are going to be joined by Sameer Goyal, the Global Head of EM and APAC Research at Deutsche Bank, for an analysis of the same three economies from the market side.